Stop loss hunting, also known as stop hunting or stop loss reading, is a controversial trading strategy employed by large market participants such as institutional investors, hedge funds, and market makers. The core idea is to intentionally manipulate the price of a security to trigger a cascade of stop loss orders placed by retail traders. Retail traders often place their stop loss orders at a predictable level, like just below a support level, above a resistance level, or at round numbers, for example 100, 500, 1000, etc. These common placements create clusters of stop loss orders in the market. Large players with their substantial capital can identify these clusters through various means, including order flow analysis or by simply observing common technical analysis patterns. Once these clusters are identified, the hunters strategically place large buy or sell orders to push the price towards these stop loss levels. For instance, if many traders have placed stop loss sell orders just below a support level, the large player might execute a significant sell order. This sudden influx of selling pressure drives the prices down. At this price hits the stop loss level, the individual stop loss orders gets triggered. A stop loss order once triggered converts into a market order to sell or buy if it's a stop loss for short due position. This automatic selling creates a further surge in selling pressure, causing the price to drop even more rapidly. This creates a liquidity event. The big players then capitalize on this induced price movement. They might have wanted to accumulate shares at a lower price. By triggering stop losses, they can buy these shares at a more favorable, artificially depressed price. Alternatively, if they initiated the movement to trigger buy stops, they might then sell at the inflated price. While often viewed as unethical, stop loss hunting is generally not illegal in many jurisdictions as long as it does not involve illegal deceptive manipulation. It is a consequence of how market mechanics, order types, and human psychology interact. Traders are often predictable in where they place their stops, and large players exploit this predictability. To mitigate its impact, retail investors are advised to avoid placing stop loss orders at obvious round numbers or extremely tight levels. Instead, using wider stops, mental stops, or placing stops based on volatility indicators like average true range can offer better protection.